On May 11th, 1931, a bank in Vienna opened its doors for the last time. Credit-Anstalt was the largest bank in Austria. It held the savings of ordinary families. It financed the industries that employed a nation. And on that spring morning, it announced losses that exceeded its entire capital base. Within 72 hours, panic spread to Germany. Within weeks, it reached London. Within months, the global financial system lay in ruins. But here is what historians still debate. The warning signs had been visible for years. Asset prices disconnected from reality. Insiders quietly liquidating positions. Credit markets showing stress that experts dismissed as manageable. The pattern was there. It was documented, and almost no one acted on it. They believed their institutions were too sophisticated to fail. They believed their currency was too strong to collapse. They believed their experts would warn them in time. They were wrong. 94 years later, the same pattern is emerging. Not in Vienna. Not in some distant economy that Americans read about in newspapers. Here, now, in the financial system that holds your retirement, your savings, your future, 3 warning signs are flashing. The same 3 warning signs that preceded 1929. The same 3 that preceded 2008. The same 3 that preceded every major financial collapse of the last century. The question is not whether you will see them. The question is whether you will recognize what they mean before it is too late. In 1556, King Philip II inherited the most powerful empire the world had ever seen. Spanish galleons carried more gold and silver across the Atlantic than any civilization had accumulated in human history. The armies of Spain controlled territories from the Philippines to Peru, from the Netherlands to Naples. The Spanish dollar was the world's reserve currency, accepted in every port, trusted in every market, the foundation upon which global trade was built. Philip II was not a fool. He was educated, strategic, and surrounded by the finest advisors money could buy. And yet within 40 years of his coronation, Spain would declare bankruptcy. Not once, 4 times, 1557, 1560, 1575, 1596, 4 sovereign defaults in 4 decades, from the richest empire on earth to a debtor nation that could not pay its own soldiers. How does this happen? How does the most powerful empire in the world fail to see the cliff approaching? The answer is the same answer that explains every imperial collapse in recorded history. And it is the answer that explains what is happening right now, in this moment, in the economy you depend on. Empires do not collapse because their leaders are stupid. They collapse because success creates blindness. The very strength that built the empire becomes the weakness that destroys it. The patterns that generated wealth become the patterns that generate catastrophe. And the people living inside the system cannot see it, because seeing it would require them to question everything they believe. Spain's problem was not a lack of gold. Spain's problem was too much gold. When silver flooded in from the mines of Potosi, it created an illusion of infinite wealth. The Spanish crown spent without restraint, wars in the Netherlands, armadas against England, palaces, cathedrals, an empire maintained by brute financial force. But the silver that made Spain rich also made Spain weak. Spanish industry collapsed because why manufacture goods when you can simply buy them with colonial wealth? Spanish agriculture declined because farming was for poor nations, not wealthy ones. The money flowed in, and the productive capacity flowed out. By the 1590s, Spain was importing nearly everything it consumed. The gold and silver that arrived in Seville immediately departed for foreign merchants in Genoa, Amsterdam, and London. Spain had become a pipe, wealth flowing through, but never staying. The Spanish court saw the numbers. They saw the debt mounting. They saw the interest payments consuming larger and larger shares of revenue. And they believed they could manage it. They believed the colonies would produce forever. They believed their creditors would always lend. They believed the system was too big, too important, too central to global commerce to fail. They were wrong. 358 years later, a different empire learned the same lesson. In 1914, Britain was what Spain had been in 1556, the center of global finance, the holder of the world's reserve currency, the power whose navy controlled the seas and whose banks controlled the money. The pound sterling was as unquestionable as the Spanish dollar had once been. London was the capital of global capital. 20 years later, Britain was borrowing from the United States to survive. 31 years later, the British Empire was being dismantled piece by piece, unable to afford the cost of maintaining what previous generations had built. What happened? The answer is not simply 2 world wars. Wars are expensive, but wars do not destroy empires that have maintained their productive capacity and financial discipline. Wars destroy empires that have already hollowed themselves out. By 1914, Britain had been living on financial engineering for decades. The manufacturing dominance that built the empire had migrated to Germany and America. British capital was flowing overseas because returns were higher in Argentine railroads and Indian tea plantations than in British factories. The City of London grew rich on fees and interest, while British industry grew obsolete. When the wars came, they revealed what the financial engineering had hidden. Britain no longer produced enough to sustain its position. The empire was running on momentum and reputation. The wars simply forced the accounting. By 1945, Britain owed the United States more money than any nation had ever owed another. The reserve currency status that had defined British power for over a century passed to the dollar. The empire that had ruled a quarter of the world's population began its long retreat to a small island in the North Atlantic. The pattern is identical to Spain. Productive capacity erodes. Financial complexity masks the erosion. Debt accumulates. And then a shock, war, pandemic, credit crisis, forces the reckoning that had been postponed but never avoided. The Soviet Union collapsed even faster. In 1985, the USSR was a superpower, nuclear arsenal matching America's, satellite states spanning Eastern Europe, a space program, a military-industrial complex, an ideology that half the world either embraced or feared. By 1991, it was gone. Not defeated in war, not conquered by enemies. Dissolved from within, unable to maintain the economic fiction that had sustained it. The Soviet collapse was not a surprise to everyone. The warning signs had accumulated for years. Agricultural production falling, consumer goods scarce, oil revenues, the only hard currency the system generated, declining as global prices dropped. The state was spending more than it was producing, covering the gap with accounting tricks and international borrowing. But inside the system, most people did not see it coming. They had grown up in an empire that seemed permanent. They could not imagine that the structures they depended on, the factories, the pensions, the certainty of employment, could simply vanish. When the Berlin Wall fell in November 1989, the Soviet Union had 900 days left. 900 days to transition from superpower to historical footnote. The people who lived through it describe a sensation of unreality. How could something so large, so permanent, so obviously powerful simply cease to exist? It ceased to exist because it was already hollow. The facade was maintained long after the foundation had crumbled. And when the facade finally fell, there was nothing behind it. This is the pattern that repeats across centuries, across continents, across every economic and political system humans have devised. Spain in 1596, Britain in 1945, the Soviet Union in 1991. The details differ, the currencies change, the ideologies vary, but the sequence is mechanical. First, genuine productive strength creates genuine wealth. Second, success breeds complacency, the belief that the wealth will continue without the discipline that created it. Third, financial complexity masks declining productivity. Debt, leverage, and accounting tricks maintain the appearance of prosperity after the reality has faded. Fourth, a shock exposes the gap between perception and reality. And fifth, collapse, fast, disorienting, and always described by those who live through it as impossible to predict. But it was never impossible to predict. The warning signs were always there. The patterns were always visible. The people who saw them were dismissed as pessimists, doomsayers, cranks who did not understand that this time was different. This time is never different. On October 24th, 1929, Black Thursday, the New York Stock Exchange experienced the worst day in its history to that point. Within 3 years, the market would fall 89%. Fortunes built over generations vanished in months. The unemployment rate reached 25%. But here is what most people do not remember. In the weeks before Black Thursday, the market had shown signs of stress. Small declines, unusual volatility, selling pressure that emerged without obvious cause. The experts dismissed it. Irving Fisher, the most respected economist in America, declared that stocks had reached a permanently high plateau. The institutions that should have seen the danger were blind to it, not because the data was hidden, but because seeing it would have required questioning everything they believed about the system they had built. They could not see the edge because they were standing on it. The question you must answer is whether you are standing on the same edge, and whether you will recognize it before you fall. In the summer of 1720, Sir Isaac Newton made a decision that would haunt him for the rest of his life. Newton was not an ordinary investor. He was the most celebrated scientist of his age, the man who had described the laws of motion, invented calculus, and explained why planets orbit the sun. His mind could calculate trajectories that other men could not imagine. And in early 1720, that mind told him something was wrong with the South Sea Company. Newton had bought shares early. He had watched them rise. And in the spring of 1720, when the mania was building but not yet at its peak, he sold. He walked away with a profit of $7,000, a fortune by the standards of the day, equivalent to roughly $1.5 million today. It was a rational decision. The valuations made no sense. The South Sea Company's actual business, trading with Spanish colonies, generated almost no profit. The stock price was built entirely on speculation, on the belief that someone else would pay more tomorrow than you paid today. Newton saw this. Newton sold. Newton was right. And then Newton watched the price keep rising. Through April, through May, through June, his friends were getting rich. His colleagues at the Royal Society were doubling their money in weeks. The rational decision was looking increasingly foolish. In the summer of 1720, Isaac Newton, the man who understood gravity better than any human who had ever lived, succumbed to a different force entirely. He bought back in, near the top, with everything he had. By December, the South Sea bubble had collapsed. Newton lost $20,000. In today's terms, more than $4 million, nearly his entire fortune. Years later, he would say, "I can calculate the motion of heavenly bodies, but not the madness of men." The madness Newton described has a measurable form. It is called valuation. The relationship between what you pay for an asset and what that asset actually produces. When valuations are reasonable, prices reflect reality. When valuations become extreme, prices reflect fantasy. And when fantasy meets reality, the correction is brutal. There is a metric that Warren Buffett has called probably the best single measure of where valuations stand at any given moment. It is simple. Take the total market capitalization of all publicly traded stocks and divide it by the gross domestic product of the nation. This ratio tells you whether the stock market is priced in line with the actual economy, or whether it has detached into something else entirely. In 1929, before the crash that would destroy 89% of market value, the ratio reached 87%. In 1999, before the dot-com collapse erased $5 trillion in wealth, the ratio reached 115%. In 2007, before Lehman Brothers and the worst financial crisis since the Depression, the ratio reached 105%. Today, in 2025, the ratio stands at 220%, not 87%, not 115%, not 105%, 220%. The total market capitalization of US stocks is approximately $66 trillion. The GDP is approximately $30 trillion. Investors are paying more than $2 in stock value for every $1 the economy produces. This has never happened before. Not in 1929, not in 1999, not in 2007. Not ever in the recorded history of American financial markets. But perhaps the aggregate number is misleading. Perhaps the economy has changed. Perhaps technology has created value that traditional metrics cannot capture. This is always the argument at the top. In 1929, it was radio and automobiles, transformative technologies that justified any price. In 1999, it was the internet, a revolution that would change everything, making old valuation methods obsolete. The argument sounds reasonable until you examine where the valuation extreme is actually concentrated. The price-to-earnings ratio measures how much investors pay for each dollar of profit a company generates. Historically, the S&P 500 has traded at a PE ratio of 15 to 16. This means investors pay $15 or $60 for each dollar of annual earnings. Today, the S&P 500 trades at a PE ratio of 25 to 28. Already elevated, already stretched beyond historical norms. But the concentration is where the true distortion lives. Nvidia, the semiconductor company at the center of the artificial intelligence boom, trades at a PE ratio above 50. Investors are paying more than $50 for each dollar the company earns. Tesla trades at a PE ratio above 180. For every dollar of profit Tesla generates, investors are paying nearly $200. These are not valuations based on current reality. These are valuations based on a future that must be nearly perfect. Years of flawless execution. No competitive threats, no regulatory obstacles, no macroeconomic disruption. For the prices to make mathematical sense. And the market has become dependent on these names. The top 7 stocks in the S&P 500 now represent more than 30% of the entire index. The performance of the market is increasingly the performance of a handful of companies trading at valuations that assume perfection in an imperfect world. Japan learned this lesson in a way that still shapes its economy 35 years later. In December 1989, the Nikkei 225 reached 38,915. Japanese stocks were valued at levels that made the American market look conservative. The Imperial Palace grounds in Tokyo were said to be worth more than all the real estate in California. The justification was familiar. Japan had discovered a superior form of capitalism. Japanese management techniques were the envy of the world. Japanese technology was dominant. Japanese banks were the largest on earth. The Nikkei would not return to its 1989 high until February 2024. 34 years. An entire generation of investors who bought at the peak and waited a lifetime to break even, if they lived long enough. This is what valuation extremes produce. Not temporary setbacks, not brief corrections that recover in months, generational destruction of wealth that reshapes economies and ruins retirements. The dot-com collapse followed the same mechanical sequence. In March 2000, the Nasdaq reached 5,048. Companies with no earnings, no revenue, and no viable business models traded at valuations that assumed infinite growth. Pets.com, Webvan, eToys, names that seemed destined for dominance, now footnotes in the history of financial manias. By October 2002, the Nasdaq had fallen to 1,114, a decline of 78%. $5 trillion in wealth vanished, not transferred to someone else, destroyed. The difference between what people thought they had and what they actually had revealed in the most painful way possible. The investors who bought at the peak in March 2000 would not break even until 2015. 15 years of waiting while the experts who told them to buy moved on to new predictions and new fees. Here is what the valuation data tells you, stripped of hope and wishful thinking. At 220% of GDP, the US stock market is more expensive relative to the economy than at any point in recorded history. More expensive than 1929. More expensive than 1999. More expensive than 2007. This does not mean the market will crash tomorrow. Valuations can remain irrational longer than most investors can remain solvent. Isaac Newton learned this in the summer of 1720, watching prices rise after he had correctly identified the bubble. But it does mean the risk is extreme. The gap between price and reality has never been wider, and when that gap closes, as it always does eventually, the correction will be proportional to the excess. The higher they climb, the harder they fall. The first warning sign is flashing red. The market is priced for perfection in a world that has never delivered perfection and never will. But valuation alone does not trigger collapses. Something else is required. A signal that the people with the most information, the most access, the most at stake, have decided to get out. That signal is now appearing. and it is the second warning sign you cannot afford to ignore. In the spring of 1929, a man named Joseph Kennedy made a decision that would define his family's fortune for generations. Kennedy was not a cautious investor. He had made his wealth through aggressive speculation, insider connections, and a willingness to operate in the gray areas of a largely unregulated market. He was, by any measure, one of the sharpest financial operators of his era. And in the months before Black Thursday, Joseph Kennedy started selling. The story that has survived, perhaps apocryphal, perhaps not, is that Kennedy's decision crystallized when a shoeshine boy offered him stock tips. If the shoeshine boy was buying, Kennedy reasoned, there was no one left to sell to. The smart money had to become the selling money. By October 1929, Kennedy had converted most of his positions to cash. While millions of Americans watched their life savings evaporate, Kennedy's fortune remained intact. He would later use that fortune to finance his son's political career, a career that would end in the White House. The lesson is not that Joseph Kennedy was a prophet. The lesson is that insiders operate on different information than the public. They see what is coming before it arrives, and when they start selling in unison, it is not coincidence. It is signal. The pattern repeated in 2007, though few recognized it at the time. In the 18 months before Lehman Brothers collapsed, something unusual was happening in the executive suites of America's largest financial institutions. The men who ran these companies, who had the most granular understanding of the risks on their balance sheets, were quietly liquidating their personal holdings. The sales were disclosed, as required by law, but they were buried in SEC filings that few retail investors ever read. The financial media, focused on quarterly earnings and stock price movements, largely ignored the pattern. By the time Lehman filed for bankruptcy in September 2008, the executives who had sold were sitting on cash. The shareholders who had trusted them were sitting on losses that would take years to recover, if they recovered at all. The information asymmetry is structural. Insiders know what the public does not know. They see the early stress in loan portfolios, the accounting decisions that mask deterioration, the private conversations with regulators that never reach the press. When they sell, they are not guessing. They are acting on knowledge that the market has not yet priced, which brings us to the present moment and the insider exodus that is unfolding right now. Warren Buffett has spent 60 years building a reputation as the most patient investor in American history. His philosophy is simple: buy quality companies at reasonable prices and hold them forever. He has mocked market timing. He has ridiculed those who try to predict crashes. He has repeated year after year that his favorite holding period is forever. In 2024 and 2025, Warren Buffett sold. Not a small rebalancing, not a tactical adjustment, a systematic liquidation of positions that Berkshire Hathaway had held for decades. Apple, Berkshire's largest holding, a position Buffett had called probably the best business I know in the world, was reduced by more than 60%. Bank of America, another core position, saw billions in shares sold across multiple quarters. The result is a cash position that has never existed in Berkshire's history. $325 billion in cash and treasury bills. More than $250 billion sitting on the sidelines, earning modest interest, waiting. Warren Buffett is 94 years old. He has seen 1973. He has seen 1987. He has seen 2000 and 2008. He has seen every market cycle of the last 7 decades. And he is holding more cash as a percentage of Berkshire's assets than at any point in his career. What does he see that the market does not? Buffett is not alone. In February 2024, Jamie Dimon, the CEO of JP Morgan Chase, the largest bank in America, sold shares of his own company for the first time in 18 years. Not since 2006, on the eve of the last financial crisis, had Dimon reduced his personal stake. The sale was valued at approximately $150 million. When asked about it, Dimon cited financial planning. The timing, he insisted, was not a market call. Perhaps, But Jamie Dimon has access to information that no retail investor possesses. He sees the credit data flowing through the largest bank in the country. He sees the delinquency trends, the commercial real estate exposure, the derivative positions that connect JP Morgan to every major financial institution on earth. When Jamie Dimon sells for the first time in 18 years, it is worth asking what that information is telling him. The pattern extends beyond finance. Jeff Bezos, the founder of Amazon and one of the wealthiest humans in history, liquidated more than $8.5 billion in Amazon stock in early 2024. The sales came in rapid succession. $2 billion here, $3 billion there, executed with a speed that suggested urgency rather than routine estate planning. Mark Zuckerberg has been selling Meta shares at a pace that has drawn attention even in a market accustomed to insider sales. Approximately $1.4 billion in 2024 alone, following similar patterns in prior years. The founders of Google, the heirs of Walmart, the executives of companies across every sector of the economy, all showing the same behavior: selling, converting equity to cash, reducing exposure to the market they helped build. These are not people who need liquidity. Bezos does not need $8 billion to pay his mortgage. Zuckerberg is not selling to cover unexpected expenses. These are strategic decisions made by individuals with more information, more resources, and more sophisticated analysis than any retail investor can access. When they sell in unison, it is not coincidence, it is coordination of perception. They are seeing something in the data, in the private briefings, in the conversations that happen in rooms you will never enter. The Rockefellers understood this dynamic nearly a century ago. In the months before the 1929 crash, the Rockefeller family and their associated investment pools were quietly reducing exposure. The public buying was met with private selling. The transfers happened slowly, imperceptibly, through structures designed to avoid attention. When the crash came, the Rockefellers had cash. They used that cash to buy assets at Depression-era prices, consolidating wealth that would compound for generations. This is how wealth transfers work. It does not happen through theft or confiscation. It happens through information, asymmetry, and timing. Those who see the collapse coming exit early. Those who do not see it hold through the decline, selling in panic at the bottom, transferring their assets to the people who were waiting with cash. The second warning sign is not a statistic you can find on a Bloomberg terminal. It is a pattern of behavior visible only if you know where to look. The people with the most information are selling. The people who build these companies, who sit in the boardrooms, who have access to data the public will not see for months. They are converting equity to cash at a pace that matches 2007. They are not telling you to sell. They are not issuing warnings or making public predictions. They are simply acting quietly, systematically, while the market continues to rise. But insider selling alone does not trigger a crash. Something must break in the machinery of credit, the system of loans and leverage that makes modern markets function. When that machinery shows stress, when the signals that have predicted every recession in modern history begin to flash, the timeline accelerates. Those signals are flashing now, and they are the third warning sign. There is a signal that has predicted every American recession since 1955. Not most recessions, every single one. It is not a secret. It is not proprietary analysis, available only to hedge funds. It is published daily by the Federal Reserve, visible to anyone who cares to look. And for 70 years it has never failed. The signal is called yield curve inversion. In a healthy economy, long-term interest rates are higher than short-term rates. This makes intuitive sense. If you lend money for 10 years, you face more uncertainty than if you lend for 3 months. You demand higher compensation for that risk. The yield curve, a graph showing interest rates across different time horizons, slopes upward. When the curve inverts, when short-term rates rise above long-term rates, it means something has broken in the machinery of expectations. Investors are accepting lower returns to lock in long-term safety. They are willing to sacrifice yield for security. They see something coming. Since 1955, the yield curve has inverted before every recession. The lag time varies, sometimes 6 months, sometimes 18, but the sequence is mechanical. Inversion first, recession second, no exceptions. The curve inverted in 2022. It remained inverted through 2023 and into 2024. By some measures, it was the longest and deepest inversion since the early 1980s. But here is what most people do not understand about the yield curve signal. The recession does not arrive during the inversion. It arrives after. When the curve normalizes, when short-term rates fall back below long-term rates, the clock starts. Historically, recessions have followed within 12 to 18 months of uninversion. The inversion is the warning. The uninversion is the trigger. The curve has begun to normalize. The Federal Reserve, responding to signs of economic weakness, has started cutting rates. The inversion is ending. If history holds, and 70 years of data says it will, the recession window has opened. Not someday in the abstract future. Now, within the next 12 to 18 months. But the yield curve is only one signal in the credit complex. The second signal is more direct, more visceral, and more dangerous. Credit spreads measure the difference between what corporations pay to borrow money and what the government pays. When spreads are tight, investors are confident. They see little risk in corporate debt. They accept small premiums over treasury rates because they believe companies will repay without difficulty. When spreads widen, confidence is cracking. Investors demand higher premiums to compensate for the risk of default. The wider the spread, the greater the fear. In the summer of 2007, credit spreads began to widen. The movement was subtle at first. A few basis points easily dismissed as noise. But by late 2007, the widening had accelerated. By early 2008, spreads on high-yield debt had doubled. Bear Stearns collapsed in March 2008. Lehman Brothers followed in September. The credit market had been screaming for over a year. Most investors did not hear it, or chose not to listen. Today, credit spreads are widening again. The pace is slower than 2007, the magnitude smaller. But the direction is unmistakable. Risk is being repriced. The market is beginning to charge more for uncertainty. When spreads jump by 50 basis points or more in a short period, that is not noise. That is the sound of professionals getting nervous. That is your signal that the clock is accelerating. The third signal is the one making headlines, though not in the way it should. Commercial real estate is entering a crisis that has no modern precedent. The numbers are staggering. Approximately $1.5 trillion in commercial real estate debt is scheduled for refinancing by the end of 2025. This debt was originated when interest rates were near zero. It must now be refinanced at rates that are double or triple the original terms. Office buildings are the epicenter. The pandemic emptied corporate offices across America. 3 years later, they have not refilled. Vacancy rates in major cities exceed 20%. In some markets, San Francisco, downtown Chicago, parts of Manhattan, vacancy rates approach 30%. A building with 30% vacancy cannot service debt that was underwritten assuming 90% occupancy. The math does not work. The building must either be sold at a steep discount, handed back to the lender, or default. The defaults are coming. Some have already arrived, but the wave has not yet crested. The loans maturing in 2025 and 2026 will force a reckoning that the market has been postponing since 2020. Regional banks are the transmission mechanism. Unlike the largest banks, JP Morgan, Bank of America, Wells Fargo, regional banks have concentrated exposure to commercial real estate. It is their core business. They finance the office buildings, the retail centers, the apartment complexes that now sit half empty. In March 2023, the world received a preview of what happens when regional banks face stress. Silicon Valley Bank collapsed in 48 hours. Signature Bank followed. First Republic required a rescue. For a few weeks, it appeared the entire regional banking sector might unravel. The Federal Reserve intervened. Emergency lending facilities were created. The immediate crisis was contained. But containment is not resolution. The loans remain on bank balance sheets. The buildings remain half empty. The refinancing wave remains on the calendar. The Fed bought time. It did not solve the problem. When commercial real estate defaults accelerate, and they will because the math requires it, regional banks will absorb the losses. Some will fail, others will cut lending to preserve capital. Credit will tighten. The businesses that depend on regional bank financing will feel the squeeze. This is how credit stress becomes economic stress, not through abstract statistics, but through the mechanical process of loans going bad, banks retrenching, and credit disappearing from the system. The three credit signals are now aligned. The yield curve has inverted and is normalizing, the pattern that precedes every recession in modern history. Credit spreads are widening, the pattern that preceded 2008. Commercial real estate is cracking. A $20 trillion market beginning a default cycle that cannot be papered over. This is not prediction. This is documentation of what is already happening. Visible in data published by the Federal Reserve, reported in bank earnings calls, disclosed in SEC filings. The signals that have preceded every major financial crisis of the last century are flashing simultaneously. Valuation extremes, insider selling, credit stress, three warning signs. The same three warning signs. But if the warning signs are so clear, why has the crash not already arrived? Why do markets continue to rise while the foundations crack beneath them? The answer lies in forces that are artificially sustaining what should have already collapsed. Forces that delay the reckoning, but guarantee its severity when it finally arrives. In the year 260 AD, the Roman Empire faced a problem that no amount of military strength could solve. The treasury was empty. Decades of war, plague, and political instability had drained the finances of the most powerful empire on earth. The legions demanded payment. The frontiers required defense. The emperor needed money that did not exist. The solution was elegant in its simplicity and catastrophic in its consequences. Roman coins, the denarius that had served as the foundation of Mediterranean commerce for centuries, had traditionally contained 95% pure silver. Emperor Gallienus discovered that if you reduced the silver content, you could mint more coins from the same amount of metal. More coins meant more payments meant more time. By 270 AD, the denarius contained less than 5% silver. The coin that had once anchored an empire's economy was now a copper disc with a thin silver wash. The empire had not created wealth, it had created the illusion of wealth. And that illusion bought time that would be paid for later, with interest. Prices rose. Merchants demanded more coins for the same goods. The soldiers whose salaries had been increased found their purchasing power collapsing. The debasement that was supposed to solve the crisis accelerated it. Rome did not fall in 270 AD. The empire staggered on for another 2 centuries. A slow decay, punctuated by moments of apparent recovery. But the debasement marked a point of no return. The foundation had cracked. Everything that followed was management of decline, the pattern repeated in revolutionary France with even greater velocity. In 1789, the new French government faced the same problem every revolutionary government faces. It had inherited debts it could not pay and made promises it could not afford. The solution was the assignat, paper currency, backed by confiscated church lands. The assignats were supposed to be temporary. They were supposed to maintain their value through the hard asset backing. They were supposed to solve the fiscal crisis without the pain of taxation or default. By 1795, the assignat had lost 99% of its value. A currency that was meant to stabilize the revolution instead destabilized the economy. The inflation that followed created the chaos that brought Napoleon to power. The lesson is always the same. Currency debasement is a tool for buying time. It does not solve problems. It postpones them while making them larger. The United States government is now running the largest peacetime deficit in American history. In fiscal year 2024, the federal deficit exceeded $1.8 trillion, or not during a depression, not during a world war, during a period of supposed economic expansion with unemployment near historic lows. The money flows into the economy through government contracts, transfer payments, subsidies, and programs. It supports consumption that would not otherwise exist. It maintains asset prices that would otherwise fall. It creates the appearance of prosperity through the mechanics of accounting. This is not a secret. The numbers are published by the Treasury Department. The Congressional Budget Office projects deficits exceeding $2 trillion annually for the foreseeable future. The national debt has passed $34 trillion, and is growing by roughly $1 trillion every 100 days. The market does not crash because the government is pumping nearly $2 trillion per year into an economy that would otherwise be contracting. Remove that stimulus. Impose the fiscal discipline that any household or business must follow, and the economy reveals its true condition. But the stimulus cannot continue forever. The debt must eventually be serviced. The interest payments alone now exceed $1 trillion annually. More than the defense budget, more than Medicare, the fastest growing line item in the federal budget. Every dollar spent on interest is a dollar not spent on stimulus. The mathematics are self-limiting. The question is not whether this ends, but when and how. There is a second force sustaining the market, and it is entirely mechanical. Passive investing has transformed the structure of American finance. Index funds and ETFs now control more assets than actively managed funds. Money flows into these vehicles automatically through 401k contributions, through pension allocations, through the systematic savings of millions of Americans who have been told to invest for the long term. This money does not analyze. It does not discriminate between overvalued and undervalued. It does not ask whether the PE ratio is 15 or 50. It simply buys every 2 weeks, every month, every quarter, regardless of price, regardless of fundamentals, regardless of risk. The result is a market that rises not because of improving conditions, but because of flows. Money enters, money buys the index rises, the rising index attracts more money. The cycle feeds on itself. But passive flows work in both directions. When sentiment shifts, when fear replaces complacency, when redemptions replace contributions, the same mechanical force that pushed prices up will push them down. The selling will be indiscriminate, automatic, and self-reinforcing. The passive investing machine has never been tested in a true crisis. It did not exist in 1987. It was much smaller in 2008. The market that emerges on the other side of the next crash may look very different from the market that entered it. The concentration makes this worse. 30 years ago, the S&P 500 was genuinely diversified. The largest stocks represented modest percentages of the index. A decline in any single company had limited impact on the whole. Today, the top 7 stocks represent more than 30% of the index. When you buy the S&P 500, you're making a concentrated bet on a handful of technology companies trading at historic valuations. If those stocks decline because earnings disappoint, because regulations tighten, because the AI narrative fades, they will drag the index with them. And the index decline will trigger passive selling, which will accelerate the decline, which will trigger more selling. The forces that have delayed the crash are the same forces that will amplify it. The deficit spending that props up consumption will eventually hit the wall of debt service. The passive flows that push prices higher will reverse into passive liquidation. The concentration that magnified the gains will magnify the losses. The delay is not a reprieve. The delay is an accumulation of energy. The longer the tension builds, the more violent the release. Something will break this equilibrium. Something will light the match. The only question is what and when. On September 26, 1929, the Bank of England raised interest rates. It was a technical decision made by central bankers concerned about gold outflows and currency stability. The rate increase was modest, 1 percentage point. The announcement received little attention in the American press. The Dow Jones Industrial Average was near all-time highs. Investors were focused on the future, not on obscure policy decisions made 3,000 miles away. 28 days later, Black Thursday erased $14 billion in market value in a single session. Within 3 years, the market would fall 89%. The unemployment rate would reach 25%. The Great Depression would reshape American society for a generation. The Bank of England rate hike did not cause the depression. The causes were structural. The debt accumulation, the speculative excess, the fragility built into the system over the preceding decade. But the rate hike was the trigger. It was the match dropped into the room that had been filling with gasoline for years. Every crash has a trigger. The trigger is never the cause. The trigger is simply the event that exposes what was already true but not yet visible. The dot-com collapse had its trigger on a Tuesday afternoon in February 2000. Cisco Systems was the most valuable company in the world. Its market capitalization exceeded $500 billion. Its routers and switches formed the backbone of the internet. The company had grown revenue at 50% annually for years. It was the bluest of blue chips in the new economy. On February 8, 2000, Cisco reported quarterly earnings. The numbers were good. Revenue was up. Profits exceeded expectations. By any conventional measure, the report was positive. But buried in the details was a single data point that changed everything. Order growth was slowing, not declining. Slowing. The rate of increase was decreasing. For a company valued on the assumption of perpetual hypergrowth, this was fatal. The market did not crash immediately. The Nasdaq would not peak until March. But Cisco's earnings report was the first crack, the moment when the narrative of infinite growth met the reality of finite demand. Within 18 months, Cisco would lose 80% of its value. The Nasdaq would fall 78%. The companies that were supposed to change the world would become case studies in speculative excess. The trigger was an earnings report. One company, one quarter, one data point that revealed the emperor had no clothes. Lehman Brothers collapsed on September 15, 2008. But the trigger came earlier, in a place most Americans had never heard of and could not locate on a map. BNP Paribas was a French bank with no particular significance to American homeowners. But in August 2007, BNP announced that it was freezing redemptions on 3 investment funds. The funds held American subprime mortgage securities. BNP could not value them. If they could not be valued, they could not be sold. If they could not be sold, redemptions had to stop. The announcement sent shockwaves through global credit markets. If BNP, a sophisticated European institution, could not determine what American mortgages were worth, what did that say about every other institution holding similar assets? The answer emerged over the following 13 months. Bear Stearns collapsed in March 2008. Fannie Mae and Freddie Mac were nationalized in September. Lehman Brothers filed for bankruptcy 1 week later. The entire global financial system came within hours of complete seizure. The trigger was a French bank suspending redemptions. The cause was a decade of mortgage fraud, regulatory capture, and the systematic underpricing of risk. But without the trigger, the cause might have remained hidden for months or years longer. This is the nature of triggers. They are unpredictable in their specifics, but inevitable in their arrival. When the conditions are present, when valuations are extreme, when insiders are selling, when credit is stressed, a trigger will appear. It always does. The question for 2025 and 2026 is not whether a trigger will emerge. The question is which trigger and when. The candidates are numerous. Commercial real estate sits at the top of the list. The $1.5 trillion refinancing wave is not a theoretical risk. It is a calendar event. Loans are maturing on specific dates. Buildings must either refinance at rates their cash flows cannot support, sell at prices their owners cannot accept, or default. The defaults will hit bank balance sheets. The bank losses will restrict credit. The credit restriction will slow the economy. The slowing economy will cause more defaults. This is a doom loop with a known starting date. The only uncertainty is how fast it accelerates once it begins. Regional bank failures are the second candidate. The March 2023 crisis was contained, not resolved. The banks that survived did so because the Federal Reserve created emergency facilities and the Treasury Department issued implicit guarantees. The underlying problems, concentrated real estate exposure, unrealized losses on securities portfolios, deposit flight to higher yielding alternatives remain. A second wave of regional bank failures would not benefit from the element of surprise. The playbook is now known. Depositors understand that uninsured deposits can vanish overnight. The next crisis will move faster than the last one. Geopolitical shock is the third candidate. The global order that has sustained American economic dominance since 1945 is fraying. Taiwan exists in a state of tension that could become conflict with minimal warning. The Middle East has entered a period of instability that threatens energy supplies and shipping lanes. Europe faces a land war that has no clear resolution. Any of these situations could produce a shock that cascades through financial markets. A disruption to semiconductor supply chains would paralyze industries that have no alternative sources. An energy crisis would trigger inflation that forces central banks to choose between economic growth and price stability. A major conflict would redirect capital flows in ways that models cannot predict. Consumer debt is the fourth candidate. American households have accumulated credit card debt exceeding $1.1 trillion. Auto loan delinquencies are rising at the fastest pace since 2008. Buy now, pay later services have extended credit to borrowers who could not qualify for traditional loans. The American consumer is not a single entity that fails all at once, but consumer stress is cumulative. Each defaulted auto loan is a repossessed car, a damaged credit score, a household that stops spending. Each maxed credit card is a family choosing between debt service and consumption. When enough households reach their limit simultaneously, the effect is systemic. Consumer spending is 70% of GDP. A consumer pullback is an economic contraction by definition. The specific trigger does not matter. What matters is that triggers always arrive when conditions are ready. The fuel is present. The kindling is dry. The matches are everywhere. One of them will strike, and when it does, what comes next will follow a pattern that history has documented with painful precision. On October 29, 1929, the stock market fell 12% in a single day. Investors called it the bottom. They were wrong. Over the next 34 months, the Dow Jones Industrial Average would decline from 381 to 41, a drop of 89%, the most severe destruction of equity wealth in American history. But the stock market was only the beginning. By 1933, unemployment had reached 25%. 1 in 4 American workers had no job, no income, no way to support their families. In some industrial cities, Detroit, Cleveland, Pittsburgh, unemployment exceeded 50%. Men who had worked their entire lives stood in breadlines. Families who had owned homes lived in shantytowns called Hoovervilles. Banks failed by the thousands. Between 1930 and 1933, more than 9,000 banks closed their doors. Deposits vanished. Savings accumulated over lifetimes disappeared overnight. There was no deposit insurance. There was no Federal Reserve intervention. There was only the brutal mathematics of insolvency. This is what aftermath looks like. Not a temporary setback, not a buying opportunity. A systematic destruction of wealth, employment, and social stability that takes years to unfold and decades to repair. The pattern repeated in 2000, though the destruction was concentrated in different assets. When the Nasdaq peaked in March 2000, it stood at 5,48. By October 2002, it had fallen to 1,814, a decline of 78% over 31 months. The numbers are abstract until you translate them into human terms. A worker who had accumulated $500,000 in a technology-heavy retirement account, a reasonable sum for someone approaching retirement after decades of disciplined saving, watched that account fall to $110,000. 20 years of savings evaporated in 30 months. The companies that were supposed to define the future simply ceased to exist. Pets.com, which had spent $11.8 million on a Super Bowl advertisement in January 2000, liquidated in November of the same year. Webvan, which had raised $375 million to revolutionize grocery delivery, filed for bankruptcy in 2001. WorldCom, once valued at $175 billion, collapsed in the largest bankruptcy in American history to that point. The venture capital that had funded the boom evaporated. The stock options that had made secretaries into millionaires expired worthless. The engineers and executives who had believed they were building the future found themselves unemployed. Their paper wealth revealed as exactly that, paper. The Nasdaq would not return to its 2000 high until 2015. 15 years. An investor who bought at the peak and held, following the advice that experts dispense in every cycle, waited 15 years to break even. They earned nothing for a decade and a half while inflation eroded their purchasing power. The 2008 crisis demonstrated that modern financial systems can destroy wealth with terrifying efficiency. In the 18 months following Lehman Brothers' collapse, American households lost approximately $13 trillion in net worth. The number is so large it resists comprehension. $13 trillion, roughly the entire GDP of the United States at the time, simply vanished from balance sheets. Home values collapsed. The house that was worth $400,000 in 2006 was worth $250,000 in 2009. The equity that families had counted on for retirement, for their children's education, for financial security, gone. Retirement accounts were devastated. The 401k that was supposed to fund a comfortable retirement lost 40% or more of its value. Workers approaching retirement faced impossible choices: continue working indefinitely, accept a dramatically reduced standard of living, or hope for a recovery that might not come in time. Unemployment peaked at 10% officially, but the real number, including those who had stopped looking for work and those forced into part-time jobs, approached 17%. 8 million jobs disappeared. Entire industries contracted. The recovery, when it came, was slow, uneven, and left millions behind. But here is what the headlines never explain. Crashes do not destroy wealth, they transfer it. The money does not vanish into the void, it moves. From those who bought at the top to those who sold before the fall. From those who panicked at the bottom to those who bought when blood was in the streets. The Weimar hyperinflation of 1923 is remembered as a catastrophe, and for most Germans it was. A lifetime of savings could not buy a loaf of bread. The middle class was annihilated. The social fabric that had held German society together was shredded, but not everyone suffered. Those who held hard assets, land, factories, gold, emerged wealthier than before. Those who had borrowed heavily found their debts inflated away to nothing. Those who understood what was happening converted paper currency to real assets before the collapse accelerated. Hugo Stinnes, a German industrialist, used the inflation to acquire companies, mines, and shipping lines at prices that bore no relationship to their productive value. By 1923, he controlled an empire, while ordinary Germans burned currency for warmth because it was cheaper than firewood. This is the pattern. Every crash creates winners and losers. The winners are those who saw it coming, who positioned defensively, who held cash when assets were expensive and bought assets when they were cheap. The losers are those who believed the reassurances, who held through the decline, who sold in panic at the bottom. The aftermath of the coming crash will follow the same pattern. Those who prepared, who reduced exposure to overvalued assets, who held cash when others were fully invested, who understood that valuations matter and cycles are real, will have the opportunity of a generation. Assets that trade today at 50 times earnings will trade at 10 times earnings. Properties that cannot be purchased at any reasonable price will sell at discounts that seem impossible from the vantage point of 2025. The concentration of wealth that has defined the last decade will accelerate, but the names at the top of the list may change. Those who did not prepare will provide the liquidity. They will sell their retirement accounts at the bottom to meet margin calls or cover living expenses. They will lose their homes to foreclosure. They will watch decades of work evaporate because they believed the experts who said this time was different. This is not pessimism. This is the documented pattern of every major financial crisis in modern history. The wealth does not disappear. It changes hands. The only question that matters is which side of that transfer you will be on. And the answer to that question depends on whether you understand where we are in a pattern that is repeated across centuries, across continents, across every empire that believed it was exempt from the laws of financial gravity. In 1683, the Ottoman Empire stood at the gates of Vienna. 200,000 soldiers, the largest army ever assembled by the Ottomans, laid siege to the capital of the Habsburg Empire. For 2 months, the fate of European civilization hung in the balance. If Vienna fell, the path to Western Europe lay open. Vienna did not fall. A relief force arrived. The siege was broken. The Ottoman army retreated. But something more important than a military defeat happened at Vienna. The Ottoman Empire stopped advancing. After 3 centuries of expansion, from a small Anatolian principality to a superpower spanning 3 continents, the empire reached its limit. It would never expand again. What followed was not collapse. It was something more insidious, a slow decline that lasted 239 years. The empire that had terrified Europe became the sick man of Europe. The military that had conquered Constantinople could not defeat regional powers. The economy that had controlled the Silk Road fell behind industrializing rivals. The institutions that had administered an empire became obstacles to reform. And throughout this decline, most people living within the empire did not perceive it. They saw problems, certainly. They debated reforms. They experienced setbacks. But the empire still existed. The Sultan still ruled. The borders still held. Mostly. The decline was so gradual, so punctuated by moments of apparent recovery, that it was invisible to those living through it. Until 1922, when the empire that had lasted 6 centuries simply ceased to exist, the Dutch Republic followed a similar arc, compressed into a shorter time frame. In 1650, the Dutch Republic was the wealthiest nation on earth per capita. Amsterdam was the center of global finance. The Dutch East India Company was the most valuable corporation in history. Dutch ships dominated global trade. Dutch banks funded the ambitions of kings. By 1750, the Republic was a second-rate power. The financial center had migrated to London. The trading dominance had passed to Britain. The military that had fought Spain to a standstill could not compete with larger neighbors. What happened? The Dutch did not lose a catastrophic war. They did not suffer a revolution. They simply stopped producing and started financializing. The merchants who had built trading empires became rentiers who clipped coupons. The capital that had funded innovation flowed overseas in search of higher returns. The industries that had created Dutch wealth migrated to nations with lower costs and hungrier workers. The Dutch remained wealthy for a time. The accumulated capital sustained living standards even as productive capacity eroded. But capital without production is consumption of the past, not investment in the future. Eventually, the capital ran out, and the Dutch discovered they had traded primacy for comfort. There is a pattern in these declines, a sequence of stages that repeats across empires, across centuries, across every civilization that rises to dominance and then falls. Stage 1. Rise through productive innovation. Every empire begins with genuine creation. Spain pioneered Atlantic navigation. Britain industrialized manufacturing. The Dutch invented modern finance. The Ottomans perfected military organization. America created the technologies and business models that defined the 20th century. This stage is characterized by hard work, risk-taking, and the accumulation of real capital through real production. The wealth is earned. The dominance is deserved. Stage 2. Achievement of global dominance. The productive advantages compound until the rising power becomes the dominant power. Trade flows reshape around the new center. The currency becomes the global standard. Other nations accommodate and adapt to the new reality. Stage 3. Financialization displaces production. Success breeds complacency. The activities that created wealth, manufacturing, innovation, risk-taking, become less attractive than the activities that redistribute wealth, finance, rent-seeking, speculation. The best minds migrate from building things to trading things. The economy grows, but the growth increasingly reflects financial engineering rather than productive expansion. Stage 4. Currency debasement begins. Governments discover they can fund their ambitions without the inconvenience of taxation or the discipline of balanced budgets. The currency is debased, slowly at first, then accelerating. Debt accumulates. The gap between consumption and production is filled with promises. Stage 5. Debt becomes unsustainable. The accumulated debts reach levels that cannot be serviced through normal economic activity. Interest payments consume larger shares of revenue. New borrowing is required to pay old borrowing. The mathematics become impossible, but the political will to address them does not exist. Stage 6. Elites extract and exit. Those with the most information and the most resources recognize what is coming. They convert financial assets to hard assets. They move wealth to safer jurisdictions. They position themselves to benefit from the collapse they see approaching. The insiders exit while the outsiders hold. Stage 7. Collapse or managed decline. The system reaches a breaking point. Either a sudden shock triggers rapid collapse, or a long grinding decline slowly erodes living standards, geopolitical power, and social cohesion. Either way, the empire that was becomes the empire that was. The uncomfortable question is where the United States falls in this sequence. Stage 1. Rise through productive innovation. The American economy from 1870 to 1970 was the most productive engine of wealth creation in human history. American factories, American technologies, American business methods transformed the world. This stage is complete. Stage 2. Global dominance. Since 1945, the United States has been the center of the global system. The dollar is the reserve currency. American military power underwrites international order. American markets set global prices. This stage is complete. Stage 3. Financialization displaces production. American manufacturing employment peaked in 1979. Since then, the economy has shifted toward services, and within services, toward finance. The profits of the financial sector as a share of total corporate profits have risen from under 10% in 1950 to over 30% at the peak. The best graduates of the best universities pursue careers in investment banking, private equity, and hedge funds, not in building companies, but in trading them. This stage is complete. Stage 4. Currency debasement. Since 1971, when Nixon severed the dollar's link to gold, the currency has lost over 85% of its purchasing power. The Federal Reserve's balance sheet has expanded from $800 billion in 2008 to nearly $9 trillion at its peak. Money is created by keystroke in quantities that previous generations could not imagine. This stage is complete. Stage 5. Debt becomes unsustainable. The national debt exceeds $34 trillion. Annual deficits exceed $1.8 trillion. Interest payments exceed $1 trillion per year and are rising. The debt to GDP ratio exceeds 120%, a level previously seen only during World War II. The Congressional Budget Office projects these trends will accelerate, not reverse. This stage is complete. Stage 6. Elites extract and exit. Warren Buffett holds $325 billion in cash. Billionaires are selling shares at the fastest pace since 2007. Wealthy Americans are acquiring foreign passports and foreign real estate at unprecedented rates. The infrastructure for exit, the lawyers, the wealth managers, the citizenship by investment programs has never been more developed or more active. This stage is in progress. Stage 7. Collapse or managed decline. This stage has not yet arrived, but 6 of 7 stages are complete. The pattern that has repeated across every empire in recorded history is now repeating here. 94 years ago, a bank in Vienna failed, and the world fell into depression. The warning signs had been visible for years before Credit-Anstalt collapsed. Valuations were extreme. Insiders were selling. Credit markets were stressed. The pattern was documented, the evidence was available, and almost no one acted on it. They believed their institutions were too sophisticated to fail. They believed their experts would warn them in time. They believed that what had happened to other nations in other eras could not happen to them. They were wrong. Today, the same 3 warning signs are flashing. Valuations at levels never before recorded in American history. Insiders selling at a pace not seen since 2007. Credit stress building in commercial real estate, regional banks, and consumer debt. The fuel is stacked. The kindling is dry. The matches are everywhere. This is not a prediction of timing. Markets can remain irrational longer than most investors can remain solvent. The triggers are unpredictable. The exact sequence is unknowable. But the pattern is clear. It has repeated across Spain, across the Dutch Republic, across Britain, across the Ottoman Empire, across the Soviet Union. It is now repeating here. The question is not whether you see the warning signs. You have seen them. The question is what you will do with the knowledge. Will you be the investor who saw the pattern and prepared, who held cash when others were fully invested, Who understood that valuations matter and cycles are real? Who positioned for the opportunity that crashes create? Or will you be the investor who believed this time was different? Who trusted the experts? Who held through the decline? Who provided the liquidity for those who were waiting to buy? The 3 warning signs are flashing. The same 3 warning signs that preceded every major crash of the last century. History does not repeat, but it echoes, and the echo is growing louder. The only question that remains is whether you will hear it in time.